companies with debt that makes up a significant portion of their capital structure, interest expenses can consume a substantial portion of profits. And that's especially true in today's interest rate environment. Debt capital is no longer cheap, in other words. So every basis point that a company can save in interest means more money falls to the bottom line. And for context, studies have shown that poor investor relations has a substantial negative impact on the market valuations of companies that have listed stock. While there haven't been similar studies for bond issuers, one can infer with a degree of confidence that effective IR supports the value of bonds and therefore reduces the cost of debt capital over time. That's why some companies have dedicated investor relations officers for debt investors and for bank credit analysts, as well as the credit rating agencies. Granted, these are large companies, but they're ones that clearly see the value of effective debt IR. So to summarize all of that, a relatively small investment in debt investor relations can substantially reduce a company's funding costs and ultimately preserve more of its bottom line. Debt IR and ESG intersect at risk, or more specifically, at the risk premium that investors demand, which can be costly for a company. As we know, the higher a company's risk levels, the higher return investors demand. For equity, that's reflected in a company's market valuation. And for debt, this dynamic is more straightforward, of course. The risk is reflected in a higher relative yield on a company's existing debt, and therefore the interest it must pay on any additional bonds that it issues. All of the factors being equal, of course. With that context, it's evident that a company must clearly and proactively communicate how it's managing ESG and other risks as part of an effective debt IR program. Otherwise, investors can misperceive those risks as being higher, the consequence of which is going to be higher financing costs that will cut into your company's profitability, as I was saying earlier. For additional context, I suggest reading our most recent blog about why ESG risk is growing in general, and therefore why effective debt IR is becoming even more important today. It's a quick read and can be found on our website, by the way. Invest in a thoughtful and consistent debt IR program. The return in terms of lowering financing costs can't be underestimated, but often is. Our view is that solid market communications over time and transparency that goes with it will help a company establish a solid reputation with the market, helping facilitate access to capital, diversify its sources of funds, and lower its funding costs. A key building block is effectively communicating financial performance. And that's not just a clear earnings press release each quarter, but holding a call with investors and analysts to sharpen their understanding of your company's financial and operating strength, which helps build confidence in management as well. We believe that higher levels of understanding and confidence are a solid foundation for issuing debt on favorable terms in the future. The other crucial building block is maintaining an adequate level of visibility in the capital markets, which helps diversify your funding sources. That means proactively marketing your company by participating in the right bank credit conferences, as well as doing roadshows regularly to meet with investors and prospective investors as well on a one-on-one basis. It also means having an adequate level of research coverage. Our view is that proactive marketing and research coverage drive investor demand for your bonds, which is crucial to maintaining an optimal valuation and ultimately lowering your cost of debt capital.